From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, Jay Powell and the Fed hold rates steady as they paint an uncertain economic picture, sending the U.S. Treasury market for its best weekly gain this month. And credit risk rises as Wall Street raises its forecast for spreads. But we begin with the big issue. Policy unknowns have the Fed on pause.
I think everyone's relieved that the Fed didn't jump to significant conclusions.
The absence of anything negative from the Fed was really seen as a positive.
They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy.
If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year.
I do think that the economic data will justify a cut by May.
Our expectation is one cut in 2025.
Monetary policy is supposed to be a long-run process.
Inflation is not the worst thing to credit investors. The economy going into recession is.
The question is, do we avert a recession? I think we do, but the risks have definitely increased.
By the end of this year, we think the economy is still growing.
I think this just makes the growth backdrop all the more critical.
Now, duration has been a double-edged sword. Take a look at this chart because traders now are loading up on duration. Open interest increased in 10-year note futures for a seventh straight session, and that is consistent with traders taking on new long positions with yields sitting near year-to-date lows. And you have seen from peak to trough a 65 basis point drop-off in that 10-year yield. Now, let's flip the board here and take a look at the Fed's median economic projections, expecting growth to slow and core inflation to tick higher. Now, that growth slowdown might be one of those reasons you are seeing people really flock to the longer end of the curve. We will talk more about it. But first, speaking of the Fed Chair Jay Powell used a familiar word to describe how he sees the impact of President Trump's tariffs on inflation.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation.
And now for the power panel, we have Priya Misra, portfolio manager at JPMorgan Investment Management, and Jerome Schneider, head of short-term portfolio management at Pimco. You look at that bid in the long end of the curve. This has been a painful trade for the past year, but now seems to be a little more certain to many investors. What is it saying, though? Is it telling you that growth is slowing, Priya?
I think it's telling you that the market's gone from being worried about the upside risk to yields because of either pro-growth policies on deregulation or taxes to those downside risks. But I would not go so far as to say that the market's pricing in significant slowdown, because when you look at the end point of where the Fed cuts are being priced in, that terminal rate that we look at, 3.5 is where the market's saying that the Fed might stop. The Fed's own estimate of neutral rate is around 3%. I think that's fair. So the market's actually saying the Fed will still be restrictive. I think that's the inflation or the stagflation aspect of the market that's priced in. So I think if we're going into a recession, or forget recession, slowdown, 1% GDP, the Fed's own forecast, I think they're going into accommodative territory. So there's a lot more for that 10-year to fall if we actually start to see the hard data, which has been robust, resilient so far. If you start to see the hard data roll over, I think you're going to see much more of that move in the 10-year.
What is the 10-year telling you, Jerome?
Ultimately, it's showing us that the market is concerned about the journey. And the journey is effectively not saying what the destination is going to be. And secondly, it's basically saying how long is that journey going to take. So for the Federal Reserve, the inflation discussion is incredibly important, and they're going to maintain that optionality with regard to how they want to think about that for the next meeting, for the next year or so. What is interesting to me was actually in the dots, where you had 2025 where inflation really became a focal point, taking it from 2.5 to 2.8%. But as you look at the future, that inflation really wasn't a concern. And hence, you heard the word transitory again. In my ear, when I hear that, I think optionality for the Federal Reserve to manage policy, et cetera. So as an investor, that inflation discussion is incredibly important. It wasn't so long ago that Jerome Powell and company were actually pointing to inflationary expectations as being something that was the anchoring point. Now they're saying, look through it. You have to reconcile that at some point in time. And for investors, the inflation discussion, at least for the remainder of Jerome Powell's term, is going to be very impactful to how the Fed decides the outcome of those dots in reality.
I want to get to the short end in a second, but I first want you to double down on the transitory word.
Sure.
People were falling out of their seats. Did it really worry you as much this time around to hear him say it?
I think people are realizing that there's probably a double-edged sword in terms of what it means. And they're also rationalizing that Jerome Powell, as well as the Fed, is going to maintain this optionality. We've seen this play before. The outcome might be different, but we've seen these cards before, and how they play them is going to be very important. There's another factor, too, which is Jerome Powell isn't around forever. His tenure is only about a year or so away. And so there might be a practical implication here where he's looking at the mirror in a few years about how the world is going to reflect upon his time as chair of the Fed. And in that situation, inflation might resonate much stronger than people and investors might suspect. In that regard, you might have a little bit more volatility in the front end of the curve and in the longer end of the curve about how people review that opportunity and how it, frankly, becomes more pervasive in the real economy.
Perfect setup, exactly where I wanted to go. You have that volatility in the short end and also in futures. You are now sitting here on Friday, and this was different earlier this week, almost 3 rate cuts priced into the market before now and the end of the year. Do you see it? Do you think traders are getting ahead of themselves? Are they looking at growth more than they're looking as much as they should at inflation?
So I would agree with Jerome. I think inflation's really important. I think the Fed's trying very hard. They've lost a little bit of credibility with transitory, which is why all our blood pressure probably rose when we heard transitory earlier this week. But they're actually telling us that now is very different from 2020-21. And I would highlight inflation expectations. I would highlight growth. There was a huge fiscal stimulus that came in post-COVID, which we're actually reversing. You can argue whether we're reversing. We're certainly not adding stimulus. And so actually, I think it was interesting that Chair Powell moved to 2018. So as important inflation is, I think they're telling us if we're like 2018, those tariffs, now they were smaller, but they didn't actually result in inflation. And look at the growth side. So back to your question around rate cuts, I think the Fed's telling us they're in no urgency. The data has been okay. They're sort of trying to look through the soft data because it's not that, or has not been that reliable. But if the data weakens, I think this Fed might be a little late to start. And then we saw last year, they can go much faster. So I wouldn't fade the 3 rate cuts this year. Maybe they start in September and 50s come back on the table. I think they're going to want to see that unemployment, or the reason they'll cut fast will be if the unemployment rate starts to rise. Whether it's DOGE, whether it's uncertainty, I think we have to talk about the uncertainty shock that the economy is facing, consumers, businesses, tariff. If all of this results in a rise in the unemployment rate, I think that's when you'll see an aggressive Fed that will not just cut a lot this year, but will talk about more cuts next year into accommodative territory.
Do you worry about stagflation at this point?
I worry about the inflation and then growth sequencing, and that growth goes hand in hand with unemployment. So that's the real issue, is if you do have an unemployment spike because of government layoffs, because of immigration, et cetera, that is a fact. But you also have a situation where, let's just take a giant step back. You still have high relative rates, high real rates, meaning inflation-adjusted rates, and the Federal Reserve doesn't necessarily need to act. And more importantly, while the market's recalibrated in small senses in terms of credit spreads and in larger senses in certain equities, the reality is that we're not in danger zone in terms of where the Fed is going to have to react to tightening financial conditions. They're perhaps slightly tight, but they're not extremely tight. So the Federal Reserve isn't perhaps going to save the day immediately in terms of risk asset appetite. But over the medium term, if growth deteriorates, yes, that is an issue. Stagflation is probably an outlier, but that gets back to the sequencing discussion of how you think the Fed's going to evolve its pricing or evolve its rate-cutting sequence.
The bond market's behaving in very interesting ways. As we sit here right now, the 5-30-year yield curve is near its steepest level since September. But at the same time, the 210 curve, which is much more watched in a lot of ways by people who are trading it, I suppose, it's gone nowhere. I mean, it's not really steepened that meaningfully. Is that fair to say, Priya?
I think that's where that stagflation comes in. The reason 210s is struggling to steepen is, do we get the inflation surge first, and that handcuffs the Fed a little bit. And so the 2-year that's already priced in all these cuts, maybe the 2-year doesn't move as much as the 5-year. We actually like 5-30 steepeners because it's hard to have a lot of conviction on when does growth overtake inflation. The Fed, this is a nightmare scenario for the Fed, the fact that they're facing stagflationary supply shocks here. So let's think about the totality of rate cuts. If the Fed's going to cut all the way down to 3% or in a recession below 3%, that 5-year has more room. The long end, I would also highlight what's happening in Europe. I think the fact that you're going to get so much duration supply from Germany, I think from the Eurozone, is going to move term premiums higher. Even without US fiscal, which I don't think you're going to get a lot of fiscal stimulus, that long end term premiums are moving higher. So the front end is more about the growth asymmetry, Fed cutting more, and the long end is supply. That's why it's steepening. So I would be a little bit further out, unless you start to, if the hard data weakens, we have a payroll report in 2 weeks, then I think 2 stands will start to steepen.
Biggest risk to the bond market at this juncture, particularly the short end?
Misinterpreting inflation, number one. Number two, the biggest risk I see, just being more on the capital preservation side, is investors just misinterpreting what purchasing power means. Meaning, if you have a higher than expected R-star neutral rate inflation, then cash sitting on the sidelines in your typical bank account is actually eroding because of higher inflation. So there's a practical implication here in terms of how investors sort of come through this territory of uncertainty.
So much uncertainty. We're going to have to keep the green highlighter out. That is Jerome Schneider of Pimco and Priya Misra of JPMorgan. A lot to digest in this market. And up next, we're going to digest the auction block because BMW, Volkswagen, they helped to drive credit issuance this week at a time where deals have been pulled. Fascinating under the surface moves. We're going to bring you that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where issuance still remains strong, even with all the market turbulence. Global sovereign debt sales will break another record in 2025 after hitting an all-time high last year. This is according to the OECD. Now, member countries are expected to issue $17 trillion in government bonds this year after raising $16 trillion in 2024. And over in corporates, the U.S. IG weekly total fell just short of estimates. But we did see notable deals from names like BMW, Volkswagen, and Citigroup. Over in a high yield, Bausch Health is said to have already drawn orders of more than $15 billion for its $4 billion 7-year secured offering. Proceeds from the sale, along with a $3.4 billion term loan, will be used to refinance debt, and the bonds are expected to price early next week with a 10% yield. Speaking of credit, JPMorgan's Ian Steely says despite all the credit turmoil, credit is still in a good place.
Corporates were in really good position, they're very healthy, fundamentally looked very sound. And I think that's what you have to step back and think about. And yes, if you see a real deterioration in growth, of course we're going to see some widening in credit spreads. But I still think there's this all-in yield argument that we've talked about a lot. People like 7.5%, there's no question about that.
Wall Street strategists, though, have been recently raising their spread forecast to factor in more risk. That includes Barclays. Dominique Toublan is the firm's head of U.S. credit strategy, joining us now, along with Amanda Lynam, BlackRock's head of macro credit research. Dominique, when you think about this new call that you've made, why? What are the biggest drivers behind the spread widening, and how far does it go?
Essentially is the deterioration in the macro picture. In a nutshell, spreads right now are pricing in less than 5% of recession risk. That doesn't sound right to me. So we push wider to say about 20% chance of recession risk. And if you look at the high level, the macro picture is both darker and cloudier, right? And if you look at the reaction of the consumer, of companies, it's been quite negative. Just one data point was startling to me this week. Philly Fed expecting new orders, largest 2-month drop ever since 1968. That doesn't sound too good. The flip side is that I don't think we can go super wide because, as you were highlighting before, companies' fundamentals, balance sheet are okay. Demand for yield, supply-demand dynamics still should be mitigating how wide we can get.
Now, Amanda, how do you play that? When we think about that deteriorating backdrop, a lot of people have still loved the yield despite the spread story.
That's right, yeah. So I think Dominique said it well. There's a more challenging growth inflation mix that probably warrants some additional widening in credit spreads, but we would view that really as an opportunity. Barring a recession, we expect demand for credit to remain robust. That includes yield-based buyers, foreign demand. But I think if I had to look forward, the one point that I would really emphasize is the growth backdrop holding in. inflation. The Fed earlier this week has shown us that inflation is expected to remain above target. So that growth backdrop really needs to hold in even at just a trend pace in order to validate, I think, acceptable market sentiment for credit. That's the one thing we're watching. We're also watching some of the lowest quality pockets of the market. CCC loans have been underperforming. CCC interest coverage, although a highly idiosyncratic group, median interest coverage is already below 1 times, and that's before we've seen deterioration in the hard data. CLOs are a massive buyer base in leveraged loans. They're rating sensitive. So these are all very technical but nuanced and important factors that we have to watch.
Right. There are a lot of people looking at the CLO market and pretty happy in some ways about the discipline it's demanding. But I do wonder about leveraged loans in particular. If you're thinking about credit risk, there are hordes of private equity firms out there dying to sell their companies, right? If you don't have the leveraged loan markets open up, do you think that investors will be okay putting money to work in those credits?
I think it becomes more difficult. Amanda was saying, if you look at the CCC cohort in loans, they haven't had time to repair their balance sheet. If you look across credit, leverage is coming down, interest coverage is still a bit lower, but it's calming down, it's lowering. But the CCC part, not that great. So if we have some hiccups in front of us, they're not that well prepared. On average, it's good. The lower end is not that great.
Now, how do you see this as well? Do you think that the market is going to be accommodative for the risky parts to come back? What would it take at this point?
I think first and foremost, it's all about growth. The one thing that we are watching is the labor market, ironically, because actually, if you think about what's driven the U.S. economic resilience, it's consumer spending in aggregate. The weakness that we've had has been confined to the low end of the consumer. If we see margins pressured because of trade policy, if we see layoffs pick up, I think that could cause even the middle and higher income consumers to pull back on their spending. That could trickle through the economy and then, of course, impact growth-sensitive asset classes like credit and like equity. I think it really just hinges upon growth. That's the driving factor, and I think we really can't rely on Fed policy and rate cuts to boost kind of sentiment in the market. So that's really, I think, the larger issue. So far, what we've seen over the past several weeks is that rates have been almost a partial hedge to risk sentiment. We've seen periods of time when rates rally a bit when risk assets underperform, but it hasn't been reliable. So I think in order to have a sustained rally in interest rates, you probably need almost a recession-like concern in the market. That's not our base case. But it's a delicate balance between the growth and inflation mix.
Of the most misunderstood factors of risk out there, which do you think is the least priced into the market right now?
Oh, that's a hard one. I think the problem is that there's so many things coming at the markets right now. So if you had asked me a couple of months ago, I would say Doge was the one. Now I think it's more complicated. If I hear what investors I talk to are saying, it's really hinging on the consumer. Right, so essentially what we've seen in the last few weeks is companies trimming their guidance quite a bit on the consumer side, on the airline side. And so the people who are dismissing that we can go really wide are saying, this is just local, this is okay. So is that deterioration we're seeing in the soft numbers so far really translating into the hard numbers? I think that's the key question and how people diverge. So if you want, everybody says wider at this point, but how much wider depends if you're focusing on the macro and the snowballing on the consumer side that could happen, or if it's looking at the balance sheet of companies and that looks fine. Sure, they're guiding down, but it's still okay.
Now, Amanda, how do you parse what's going on in the consumer? Very admittedly, I'm at that part of the cycle where I'm looking for everything. I'm even looking at Experian data that can grab FICO scores across income cohorts to see what's going on. Right. Because we're soon awaiting bank earnings as well. Right. We'll get a lot more data very soon. But what are you looking at to see exactly where the consumer stands today?
I would say high frequency data from the labor market is first and foremost. Company level commentary, which was really important in the pandemic around supply chain disruptions. The 5% unemployment rate has been kind of this target that has been communicated as that's where the consumer backdrop really starts to deteriorate. But as you know, deterioration in the labor market is high velocity and nonlinear. And so I was actually surprised to see the Fed write down a 4.4% unemployment rate in their SEP. Usually they respond to unexpected weakness in the labor market. It seems like we might need to weaken beyond that before they respond. And I think that journey on the way to 4.4 could be very quick to 5%. And so I think it really is the high frequency data from the labor market as it relates to the consumer.
Dominique, when you think about the consumer as well, do you think that there are maybe parts of the market that are not understanding how weak the consumer might be. You know, just this morning, for example, I never expected to mention this stat in Real Yield, but you have buy now, pay later loans being offered on DoorDash. So it's a little hard to know just how levered the consumer is, isn't it?
100%. So the difficulty, if you look at the high-level data, the consumers like companies. The balance sheet looks fine. The interest expense is what's been, more difficult. So what you've seen so far is the lower end of the consumer being in trouble, or at least difficulties. But that's only 10% of consumer spending. So for the average of the economy, that's quite okay. The problem is the contagion. But what are the channels you can see? Doge is one. So we looked at expenses per zip code. And we look at zip codes where government employees are large. Guess what? In February, in March, they lowered their expenses compared to other zip codes. And so that's what you can see. That's middle class, right? Or upper middle class. So do you see a contagion there? And that, if the middle class steps back, it's a very different story. Saving rates jumped up in January. Is that the sign of the consumer saying, I'm not quite sure what's going on here. Let me take a step back. But as you, looking at tons of data, planning for vacation in the summer, coming down, all these kind of things. We're all in the same, what is the noise, what is the signal right now?
Absolutely. Dominique, Amanda, we thank you both for joining us. That is Dominique Toublan of Barclays, BlackRock's Amanda Lynam. Of course, parsing through the noise, there is a lot of it. Now, I want to bring you some breaking news as well, because we have been following news out of London Heathrow. The airport, which was shut down after a fire has caused, a nearby fire caused the worst disruption in years, they will now resume partial service today and full operations tomorrow. There was a fire that cut off power to the airport in the worst disaster in years. It canceled over 1,000 flights, roughly 1,300. We will keep you updated with more news as we know it. Of course, this is a massive transatlantic hub, and people are just trying to get home. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Coming up is Monday. Atlanta Fed President Raphael Bostic sitting down with an exclusive interview with our own Bloomberg's Michael McKee, plus BYD earnings that day as well. Tuesday, new home sales and consumer confidence, a big one that people are watching. Wednesday, U.S. durable goods and earnings from Dollar Tree, SailPoint, and Chewy. Thursday, U.S. GDP, another one that people are watching closely. Also, weekly jobless claims. Friday, U.S. core PCE, personal income and spending, and the UMich sentiment survey. So much consumer data. But for my final thought, let's look ahead to PCE inflation data next Friday. The data expected to show the core gauge rising to 0.3% in February and to over 2.7% year over year, which could mean a further stalling from the Fed's 2% target and affirming the central bank's decision to hold rates. But from New York, that does it from us for now. Same time, same place next week. This was Real Yield, and this is Bloomberg.